Hello and welcome. In today's video, I am analyzing Kalpataru Power Transmission Limited. This analysis I am doing it for one of my client. So if this is also helpful to you, you may want to subscribe to the channel and like and share if you want to with your friends. Let's continue with the Kalpataru Power Transmission Limited. The company is engaged in the business of manufacturing of structural metal products, tanks, reservoirs, and steam generators, construction of roads and railways, construction of utility projects, electricity, power generation, transmission and distribution. So quite a varied businesses or different kind of businesses they have, or sections of the businesses they have. Let's look at their financial statement. Currently the market cap stands at around 4,317 crores and the net worth of the company, that is its book value, is at 225 rupees per share and the current price is 279. So the market cap to book is almost like 1 times, slightly more than 1 time. So this is quite reasonable currently. Its highest point it had reached was around 4. The highest point it had reached was or the highest price it had reached was 477 rupees and the lowest it had reached is 170 rupees, and currently it is somewhere between its highest and the lowest point. The current price earning is 13 times, that is its price is 13.8 times more than its profit per share of the latest 12 months. Dividend yield is 1.25%, again quite low. Return on capital employed is 20% latest. ROE 11.9% again latest. So return on capital employed is quite good. Return on equity is below 15%, below my level. Face value stands at around 2 rupee per share. Around 15.5 crore equity shares are outstanding in the market. OPM margin over the last 5 years is quite low at 12.4%. Debtor days, that is 5 years back it took around 114 days. It required 114 days to collect payment from its customers, and currently it is at that is 3 years back it's 166 days. So it's quite high when we look at how efficient the company is. Its market cap 3 years back was 4,952 crores, 5 years back 3,368 crores, and 7 years back 1,258 crores. So it has managed to gain market cap over the years gradually, and currently it is below its market cap which was 3 years back. So basically we are getting the companies per share somewhere where the price was around 3 years back, or somewhere where it was slightly more than where it was 5 years back. It has given a negative return over the last 1 year of around almost 37.9%, and over the last 3 years, if somebody had invested 3 years back, they would have suffered a loss of around 10.8% compounded over the 3 years, and from 5 years back gained just 2.49%. So this company has not given good returns to the investors. Cash flow from operations is 4,734 crores over the last 7 years. If we compare this with the market cap 4,317 crores, so almost more than, so basically market cap has gone below its cash generated over the last 7 years. So we are getting it at a good discount if you are interested in buying this. Free cash flows is still half of the cash flow generated over its last 7 years of around 2,133 crores. So this is good. So it is generating cash. Debt is 2,732 crores, almost 50% of the cash generated and 50% of its market cap. So the debt is quite high if you look at that way. Preceding year it was 2,610 crores, so the debt in the recent 12 months has not increased that substantially, but from where it was 3 years back also it has come down slightly by around 200 crores or so. Debt 5 years back was 3,684 crores. So this is a good thing that we are seeing that the debt is reducing in the company's books from where it was 5 years back to where it was 3 years back, and now at 2,732 crores. Company doesn't have that much of investments. In fact, almost zero investments, and cash holding of around 412 crores. Trade receivables are around 4,317 crores. So the company is reducing its debt from 3,600 crores 5 years back. So we see a good thing that at least the company is reducing its debt over the years. As I mentioned, investments and cash holding is 412 crores, which is approximately around 10% of its cash earned over the last 7 years. So it's not that substantial, but it's okay. Trade payables and trade receivables are almost the same. The company still has to collect 4,317 crores from its customers compared to how much cash it is earning over the last 7 years. So then it becomes very risky. If the company is earning 4,700 crores in cash over the last 7 years and it still has to collect from its customers 4,317 crores, so this looks very dicey and like a red flag. So you have to be careful. Company also has to pay its suppliers around 3,129 crores. So these values are not very good. If you look at the debt of 2,700 crores and payables of 3,129 crores, this is not good. Working capital is positive 2,312 crores. So basically its current assets are more than its current liability. So it has a good current asset liability match. That is, it will be able to pay off its liabilities from the asset it at least owns. It has an asset of fixed assets of around 3,418 crores. 3 years back it was 3,000 crores and 5 years back it was 3,200 crores. So the assets haven't grown over the years that much, and that is why we see a free cash flow of almost 50% against the cash earned in the last 7 years of 4,700 crores. So the company's assets are around 3,200 crores, quite a substantial portion if we see, and the trade receivables is also very risky at 4,317 crores. Moving on, we'll look at the pros. Company has delivered a good profit growth of 27% compounded over the last 5 years. Promoter holding has increased slightly by around 1% over the last 1 quarter. The ROE is quite low at 13.27% for last 3 years. Generally, I would like to see it above 15%. This is one of the major problem. Promoters have pledged 57.5% of their holding. This becomes quite risky. If the promoters don't clear their pledge or pay the bank or repay the banks would generally sell off these shares in the open market to recover their dues, and that would create a huge fall in the price of these shares. Company's cost of borrowing seems high. Promoter holding has decreased over the last 3 years by 4.3%. So this needs to be kept in mind as to why the promoters have pledged, and since how long have they pledged 57% of their holding. Next, let us compare Kalpataru with Kec International. To be clear, I am not invested in this company. As I mentioned, I am doing this analysis for my client and hoping this would be helpful for someone else who may be invested in Kalpataru Power or Kec International. These are very basic ratios. You also need to look at cash flow statement. I don't have that much time to go and do analysis right now in this video, but I would be doing that off video and looking at cash flow statement, balance sheet, and then doing a detailed comparison as to how much investment is there by the FIIs, DIIs, and so on. Kalpataru Power is down almost 41% from its 52-week highest point that it had reached, whereas KC has recovered quite a bit and has now just need to go up or it is down 5% from its 52-week highest point. The data is up to date till September 2020, that is quarterly, and annual results are up to date till March 2020. So these results are up to date. Sales has grown for KEC by around 15% from September previous quarter, from 2,800 crores to 3,200 crores. And Kalpatro has seen a drop in its sales by around 5.72% from 3,216 crores to 3,032 crores. In terms of profit has fallen slightly for Kalpatro at around 1%, from 132 to 144. So there is not substantial change in Kalpataru Power's quarterly sales and profit values from their respective previous quarters. KEC has seen a slight growth in its profit by around 2%. In terms of sales, where it was in 2020 and where it is in the recent 12 months, it has gained, KEC International has gained in terms of revenue from 11,965 crores to 12,200 crores, whereas Kalpatro has seen a slight drop in its sales from 12,600 to 12,050 crores. So not substantial change in terms of revenue generated in the recent 12 months compared to 2020 or March 2019 for rather that. Profit 565 crores to 551 crores, that is from the recent 12 months to 2019, or rather March 2020, sorry. So 565 crores in March 2020 to 551 crores in the recent 12 months. So slight drop in its profits. Even Kalpatro has seen a slight drop over March 2020 values. Cash generated by KEC is just 87 crores in 2020. So although it was showing a 565 crores of profits, cash is not being generated by this company. So this becomes quite risky. So I would want at least equal, the cash generated to be equal to the profit after tax, or around slightly less than that, but not that substantial change or variation between the profit earned and the cash flow shown, or rather the cash flows earned and profit shown in the P&L account. Kalpatro's cash generation is quite high, almost 3 times, or rather 2 point some odd figure values, 2.4 2.5 times more than the profit declared. So this is good. At least this gives us a confidence. But then there are a lot of other issues with this company. That is, the promoters have pledged their shares, the debt is very high, the amount of debtors, that is payment to be collected from the customers, is very high. So all these things become quite risky. So you have to keep in mind overall everything as to what the values are basically representing. KEC's price earning as of today is 15.8 times. We are paying 15 times more than the profit earned per share to buy each share, whereas over the period of last 5 years or 3 years also it was around 15.5 times. So the current PE is almost near its average. Kalpatru also current price earning is slightly below its average of the last 3 years of 15.4 times. So this has become quite attractive as of now. Although I would not recommend my client to buy into both of these companies, or at least Kalpatru. Current market price to OCF is 4.6 times, whereas KEC is 100 times. So we have seen earlier that although it had earned a profit of 565 crores, only 87 crores was generated in cash. So that's almost the current market price to OCF is 100 times. That is, the price as of today is 100 times more than the cash it has generated. So the price was what? Around 340 rupees, the current market price, and the cash generated is just 87 crores. The price to book for both the companies, at least KEC is quite high at 2.8 times. It should be below 2.5, that's my benchmark. Kalpatru is 1.24 times, so it becomes quite reasonable. So if somebody is already invested and they want to come out of this company for whatsoever reason, then they can look at these values to see where they want to average or accumulate more. The PG for both the companies are good. They are both below 1.5 times, or rather not times but 1.5. PG basically represents price earning. What is the price earning, and then compares it with the profit growth of the last 5 years and of the last 3 years. So both these companies' revenue or profits have been generating or growing at a compounded rate of 56 and 21%, for Kalpatru 27 and 35%. But these values, whenever they go about 20% growth rate, they need to be checked individually for the values and not for percentage growth, because this could mean that 5 years back the company's profit had dropped quite substantially and now it has increased. So that does not make sense. So you have to go individually to that year, 5 years back, look at what is the value, whether the value is seeing a growth over the years or not. If it is not seeing a growth, then actually it does not make sense, even this high growth rate. So you have to be careful as to what this also represents. Sales has been growing at 7% over the last 5 years and 11% over the last 3 years for KEC, and 12 and 19% for Kalpatro. So both of these are in positive values. So until unless we see growth in the sales values, so this is considered good. ROE values for Kalpatru for all 5 years, last 5 years on average, 3 years on average is below 15% benchmark. KEC is earning around 20% or more in terms of return on equity over 5 years, 3 years and the recent 2020 as well. Return on capital employed is also about 20% for KEC, whereas Kalpatru has slightly increased its ROC to 20%, whereas over the 5 years it was 16 and 19%. So at least it is quite efficient in terms of generating profits on the capital employed. Return on total assets is low for Kalpatru at 4% and 3%. So we can see at how the other companies are doing. The other companies are in fact in negative, but when we looking for Kalpataru Power, we have to compare it with a better company than to compare it with a worse company. So when we look at KEC, KEC is generating around 11% on its asset. So it is more efficient than Kalpatru. So if somebody is stuck in Kalpatru, they can switch over to KEC because KEC is more efficient than Kalpatru in that sense. But we have to look at everything in totality to make our decision. The company is also turning over its assets into sales at 2.25 times, better than Kalpatru at 1.9 times. That is, its sales is 2.25 times more than the assets employed into the business, and its sales around 8 times more than the inventory holding it has. So it is more efficient than again Kalpatru, whose sales is just 4.6 times its inventory holding. Again, you cannot look at inventory turnover in isolation. You have to look at the actual values also. Profit after tax in last 3 years generated is around 1,983 crores, and the cash generated is around 2,500 crores. So more than the profit of the last 5 years. So this is good. Whereas Kalpatru has also generated a high amount of cash from 1,300 to 4,400 crores. Earlier in the 2020 values, we saw here that KEC had generated from 565 crores in 2020 as profit, but shown cash of only 87 crores. So this was a mismatch, but it was for 1 year. But when we look at the 5 years data, so that is good because 1,983 crores of profit and cash of 2,500 crores. So we have to look at long-term picture. If you are investing for 3 and 5 years, then we have to also look at long-term picture rather than just wait and concentrate on just small or a 1 year picture. Kalpatru is also generating a good amount of cash against the profit declared. Both the companies have almost the same amount of free cash flow as their cash flow generated over the 5 years. So they don't have much investments or need for investing in fixed assets as of now. Or rather, we can see it also in this sense that they don't have growth or they don't see growth. Otherwise, they would invest back into the company and wouldn't have that much of free cash left over the last 5 years. KEC is earning around 396 crores of profits on average every year, whereas Kalpatru is around 276 crores. KEC is slightly almost twice the size of Kalpatru in terms of market cap. Kalpatru is 4,300 and KEC is 8,700. Net worth wise, both the companies are almost the same. In fact, Kalpatru is 3,400 crores yet its market cap is 4,300 crores, whereas people in the market or investors in the market have given quite a high valuation to KC. Now if somebody is willing to buy by paying almost 2.34 times more than its net worth, then there has to be something in this company, and that is why it is getting such high price to book valuations. So we have to look at overall what people in the market are also doing. Contingent liability 952 crores, which is around slightly more than 20%. So it's become slightly risky. Anything below 20% is good. Whereas contingent liability of Kalpatru is around 816 crores, which is again around 20% or so. So these are okay, not that big a deal for contingent liability for both the companies. Both the companies' debt to equity is below 1 times, which is good, but the coverage is still not that efficient for both the companies. Their coverage, at least for KC, is better than Kalpatru at 3.73 times, meaning the EBIT that the company is generating as generated in 2020, that EBIT is around 3.7 times more than the interest it paid. If you don't understand any of these ratios, because I'm going very quickly, then you can look at my detailed analysis of many of these companies that I've analyzed over the year, and you can go through them, you can listen to them, and see how I analyze each company in detail to understand whether I should invest or not. Moving on, the Kalpatru's interest coverage is again quite low at 2.2 times. Basically, its interest cost, or rather its EBIT, is 2 times more than the interest it paid. Promoter holding for both the companies is above 50%, but here the problem with Kalpatru is 57% of that is pledged, so it becomes very risky. Whereas KEC's promoters have not pledged any of their shares. Debtors to sales is also very bad for both the companies. 41% should not exceed more than 30% of sales. So Kalpatru is almost 35%, which means that whatever sales it did in 2020, against that almost 35% of that is still pending to be collected from the customers, whereas KEC is taking 41 days. The other companies, though, we can just ignore completely. Debtor days also very high for both the companies, should not be more than 90 days for the companies. So both of these companies are taking huge number of days and a huge percentage of sales to be still collected from the customers, or pending to be collected from the customers. NPM for both the companies is quite low. Again, I would not suggest anyone buying both of these companies, but if someone is already invested, it is KC is much better than Kalpatru, in at least when I'm analyzing these numbers, basic numbers. The dividend yield is around 1% for both of them. So this completes my detailed analysis of Kec International and Kalpataru Power. If you like this video, do share it with your friends. Thank you for watching this video.